Hello everybody, what's going on? Few big updates are coming from Onvo's end. The news is simple, but the implications are massive. Onvo, which is NIO's foray into the mainstream segment with vehicles like L60 and L90, has unveiled plans to essentially double the number of available battery packs at its shared power swap station. We are talking about deployment of over 8,000 new battery packs compatible with Onvo vehicles, all set to be completed by mid-January 2026. Now, on the surface, this might sound like a simple customer service move to prepare for the heavy travel surge during the Chinese New Year holiday. And yes, it is that. But for investors, this is the most critical takeaway. It strongly suggests that the battery production capacity constraint that have throttled NIO's delivery growth and depressed its stock price have finally been resolved. Remember, scaling their unique model requires two things: building the power swap stations, which they have already done brilliantly, and ensuring a high density of available charge batteries inside those stations. Previous reports indicated that battery supply was lagging demand, causing bottleneck in the vehicle deliveries. By announcing this massive ramp up of 8,000 plus packs in such a short window, NIO is signaling that they are now able to feed the beast. They are clearing the path for volume growth. And this is where financial analysis gets exciting. The core of NIO's future lies in its battery as a service or BAS models. BAS is designed to lower the upfront purchase price of the vehicles, attract customers with guaranteed future battery upgrades. This doubling of available packs does two things for economics. First, it increases the utilization rate of highly expensive power swap station assets, improving the return on investment capital. This shift the PSS network from a cost center to a profitability driver faster. Second, it strengthens the competitive moat. No other major EV player in China or globally can offer the convenience of a 3-minute battery swap. As Onvo pushes this tech into the mass market, the vast, robust, and readily supplied swap network become an unbeatable point of differentiation. You are not just buying a car, you are buying access to the industry's most convenient energy solution. Here, I would say that this brand Onvo has a multiplier effect because their vehicles are designed to compete directly with models like the Tesla Model Y. They are NIO's high volume segment. For a family buying Onvo L60, the decision is often driven by the value and convenience. Doubling the available battery supply directly tackles range anxiety and wait time anxiety, the two biggest psychological hurdles to mass EV adoption. By eliminating these concerns for their most important volume brand, NIO is effectively throwing open the doors to the middle market buyers. Furthermore, this infrastructure validation is crucial for their strategic vision. NIO has been actively seeking to license its power swapping technologies to automakers with confirmed partnership already in place with companies like Chang'an and Geely. What do those partners need to see? They need to prove that NIO can reliably build, operate, and supply the network with batteries at scale. This massive 8,000 plus pack deployment is that proof. It's a strategic move to show partners that the infrastructure backbone is ready for a multi-brand future, turning NIO's power business unit into a highly valuable, high-margin technology provider across the entire industry. The narrative around NIO is finally shifting. They have overcome a major self-imposed hurdle, the battery supply constraint, and are now fully utilizing their proprietary advantage. NIO is transitioning from being viewed simply as a high-end EV maker to an infrastructure and technology ecosystem powerhouse. Their core value proposition is the fastest, most convenient refueling method available, and they are now proving they can scale it for the mass market through Onvo. For long-term investors, this announcement is a bright green light. It signifies that company is moving past execution challenges and is now positioned to leverage its unique infrastructure moat for accelerated volume growth, recurring BAS revenue, and valuable technology licensing deal. All these things shows that we are moving towards a highly profitable and differentiated business model. The stock current valuation is simply not pricing in the power of this fully operational scaled up infrastructure play. Once company will execute all these plans, then definitely analyst and market will also re-rate the stock and we will see some good momentum. So get ready for it. With that said, thank you so much for being here. See you in next one.